Everything you need to know about mutual funds. That's our topic for discussion today in the Market Secrets Investment Series. A mutual fund is an investment vehicle by which a company, which is called as an asset managed company or AMC, collects money from the investors by selling units or shares and using that money to make investments. Depending upon the mandate, a mutual fund can invest in equities, bonds, a mix of both, gold, international equities, or in other mutual funds as well. So the mutual fund automatically does not mean equity mutual fund. Equity mutual funds are just a subset of the mutual funds. There are some 4,000 odd mutual funds currently available in the Indian markets. So whenever they say mutual funds, don't think that is just all equity mutual funds. There are other mutual funds as well. What is a portfolio? The combined list of securities held by a fund is called a portfolio. Because of transparency requirements, the companies have to periodically update the portfolio of their funds in their websites. Equity mutual funds will list the stocks they are invested in. For debt mutual funds that invest in various IOUs or bonds, it is required to disclose the portfolio every 2 weeks. Different portals like moneycontrol.com shows different details along with other important information like percentage holdings. Now comes the important question. What is net asset value or NAV? This is the price of one unit of a particular mutual fund. It is calculated by adding the market value of all the securities, that is equities, bonds or gold. Whatever the fund is holding, we need to add the market value of all the securities and you have to subtract the market value of the liabilities and then you need to divide this value by the total number of outstanding shares. So this is how you need to calculate the value of the NAV. NAV is calculated daily at the end of the trading session and should be available on the AMFI website by 11 p.m. Some funds which invest in foreign assets can have delayed announcement of their NAVs. If the underlying market value of the security increases on that day, NAV will increase and vice versa. Your purchase or selling price of the mutual fund will be known only after NAV announcement at the end of the day. So you won't exactly know the price of the mutual fund units you will be buying. So at the time of buying, you won't know at what price you are buying these mutual funds. Only after the NAV is published on that day, you will know your buying price. Mutual funds can issue fractional unit up to 3 decimal places. A fund can collect 1 lakh rupees and issue 1000 units with NAV of 100, or they can collect the same 1 lakh rupees and issue 10,000 units at the NAV of 10. The underlying net value is same, only the NAV value is different because of number of units. This is why when someone tells you that the fund with the NAV of 10 is better than the fund with the NAV of 100, you should not agree to it. The total value of the fund depends upon the securities and not the NAV. You should better avoid such advices. So what is a dividend income from mutual funds? When a mutual fund announces dividend, it pays out the dividend money from the net assets and gives it back to the investors. There is no additional money being generated here. This is exactly how the companies distribute part of their profits to the shareholders as dividends. If NAV is 100 and the AMC announces dividend of 5, you will get 5 rupees for each unit in your account, but the NAV of the mutual fund will fall to 95 rupees. Your own money is being given back to you as a dividend here. It is not like you will get 5 rupees in your account and the NAV will continue to be 100. This is a very big misunderstanding people have on dividends. Instead of relying on mutual fund dividends for cash flow, it is easier to just withdraw it yourself. Both will result in the same thing. So always avoid dividend option. Moving on, what is an NFO or new fund offer? Companies come up with new portfolios and create new mutual funds accordingly. One can read about the details of the new fund offer on their websites or in the SEBI website. Usually, these are sold at the NAV of 10. The underlying philosophy of the fund is more important, and before buying an NFO, one should see whether that philosophy fits into your investment requirements. Any NFO requires a lot of advertisement, that is online or offline advertisements, seminars and sellings. All these expenses are deducted from the net assets in the liabilities section specifically, and it gets reflected in the NAV. For 99% of the cases, don't invest in NFOs. It is also a misconception that funds NAV cannot be smaller than 10. A fund can definitely go below the NAV of 10. Now comes the interesting question, what is expense ratio? The funds charge a specific amount of money for using the services. This charge is applied on a daily basis and comes under the liabilities head in the calculations. If a fund charges 2.5% expense ratio, then it would deduct almost 0.01% on each working day. That is 5 days a week for 52 weeks from the net asset value of the funds and give you the final NAV. For lower expense ratios, this value will be lesser. Each mutual fund have two types of plans, a regular plan and a direct plan. If you invest directly with the AMC through their official website and you opt for the direct plan, you will get lower expense ratio. But in all other method of investing, namely using the bank agents or using the banks or investment accounts, you will get the regular plan of the mutual fund. This will increase the expense ratio by 0.5 to 0.9 percentage easily. You can also invest through various new generation platforms like Coin, Grow, IND Money, Kuvera, MF Utility, Paytm Money, etc. But make sure you are investing only in the direct plan of the fund and in the growth scheme. So what are the types of mutual funds? There is an open-ended mutual fund and there is a closed-ended mutual fund. What is the difference between these two? An open-ended mutual fund is a mutual fund where the buying and selling of the units from the AMC is open all the time. If you buy, they create more units at the end of the day, and if you sell, they can remove those units. So you will be able to buy open-ended mutual funds on any trading day. But the closed-ended mutual funds are different. If you take a closed-ended mutual funds, the AMC does not allow creation or deletion of units every day. For a 3-year closed-ended mutual fund, the AMC does not allow creation or deletion of the units for a period of 3 years. After 3 years, it can either convert it into an open-ended mutual fund or pay back the money and close it. During the 3-year period, the investor can buy or sell the units on the exchange from other unit holders. This is simply a transfer of existing units from one investor to another. But the liquidity will be low in this case and the spread will be high, due to which buying or selling price can be different from the NAV of the fund. And sometimes one may not be able to sell it if there are no buyers. There can be 5-year closed-ended mutual funds too, and there are some funds which open only once every year for new investments. The best example for closed-ended mutual fund is FMP, that is fixed maturity plans. This is a commonly used closed-ended mutual fund, and this is purely for a debt investment. I used to invest in fixed maturity plans in the past, but now I don't. I'm strongly against investing in any debt mutual funds in India except for the liquid funds, that too high quality liquid funds. And lastly, what are the advantages of mutual funds? Number one, diversification. Most funds have number of different securities in their portfolio. Some can have stocks of 25 companies, while others can have stock of 100 companies. There are guidelines which prevent the companies to invest in only 2 or 3 companies. This prevents severe losses in case one company is involved in fraud and its stock prices collapses. Same is the case with the bond funds. They can have bonds of different companies, and even if 1 or 2 companies default, the overall NAV does not go down to zero. The next advantage is affordability. With 500 or 5000 rupees, you can go and buy mutual fund units and get the diversified portfolio. If you want to replicate this kind of diversified portfolio on your own, you will need to have a bigger amount. The next one is professional management. The management team employed by the AMC use their expertise, research, and analysis to make the portfolios. This is better than most of the retail investors. The main point is that the aim of the management is same as that of an investor, to maximize the NAV, which is nothing but your investment value. And number four is liquidity. By definition, open-ended mutual funds can be sold back to the AMC and the money can be received in the bank account anytime. Depending upon the type of the fund, it can take 1 to 7 days for the amount to get transferred. So mutual funds are highly liquid. And lastly, the convenience. Most of the things like buying, selling, statements, tax statements, KYC, setting up or cancelling an SIP, STP can be done completely online. Also, everything can be done by going to AMC office as well or through common service portals like CAMS or Corvi. So you can sit at home and you can simply invest in mutual funds. So these are the major advantages of mutual funds. And with this, we have covered everything that you need to know about mutual funds. If you have any queries on this episode or about mutual funds in general, please feel free to drop it down in the comment section. We'll definitely answer it. Hit the like button if you have liked this video and share it with your friends if you find it useful. Also subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.